Hello, in today's episode of MK Fund Manager's View, I'm happy to introduce Kashyap Javeri, Fund Manager, MK New Vitalized Fund. Welcome, Kashyap sir.
Thank you so much, Prachi.
I would like to ask you a few questions about NV strategy. So, shall we jump to the questions?
Sure.
Okay. As a fund manager of manufacturing theme fund, what are the key trends you have observed?
So, Prachi, we started this strategy almost about now. It's an 18-month-old strategy, and we have done phenomenally well. Touch wood, by God's grace, we have done phenomenally well. But I think the way we got idea of this strategy almost about 30 months ago is that we saw India manufacturing on its own doing amazingly well. Everything about Atmanirbhar Bharat, about PLI schemes, everything came probably 6 or 12 months later, worked as an icing on the cake. But I think the key highlight of this strategy is that India and within our economy, the manufacturing sector on its own is doing phenomenally well, whether it's return on capital employed, whether it's repairing of the balance sheets in terms of debt to equity ratio, whether incrementally less and less investments happening into working capital, or whether it's later on the government support in terms of, let's say, reduced taxes, in terms of PLI scheme, in terms of ease of doing business, all came later. But I think if you look at across all about 12 to 13 odd industries within manufacturing as an umbrella, everybody is doing phenomenally well in terms of better ROCs. Everyone is doing phenomenally well in terms of how much they are saving in terms of working capital and how much of money they are using that to pay debts and how much of money they are using in terms of putting up new capacity. I think that's behind this success of this whole strategy, that all these are firing on full cylinder at the same point of time.
We can say you identified the trend before it became a trend.
That will be giving too much credit to me, but I think the credit goes to every industry within that manufacturing, that they have used this whole COVID crisis and turned it head on into an opportunity over last probably 3 months, and they have used the whole crisis to repair balance sheets, to improve cost structures, and eventually because of this to improve the return on capital employed. I think every manufacturer and every investor looks at that's the ratio that everyone looks at, and I think that's looking probably better than what we have seen for almost last about 15-16 years.
Great. As the saying goes, never waste a good crisis.
That's what I think is the crux of this whole story.
Perfect. So your NV fund has shown some phenomenal performance since inception. So what would you say about it?
So if you look at October 2023, since inception basis, our NAV is up almost about 50% plus.
Wow.
Over a period of about 18 months. That means a compounded annual returns in excess of almost about 30% for last 1.5 years. I think a lot of, like I said, the strategy capitalized on the fact that we saw manufacturing as a part of the economy moving up the curve. What has also benefited us a lot is our selection of the right sectors within that manufacturing, and within the sectors the right stocks that we have selected. I think overall that's what has contributed to this whole performance. The sector itself doing well within the economy, within sector the right industries doing well, and within the right industries our stock selection is something that's contributed to this phenomenal performance.
That's amazing. So what do you think is the key to the success, and which ones have been your most performing stocks?
So I think in terms of sectors, we capitalized on the theme of auto and auto ancillary, which is part of overall discretionary spends. We also capitalized on the capital goods story, because like I said, when the ROCEs have been improving, the return on capital employed has been improving, and balance sheets are getting significantly cleaner. What we see is Indian corporates are very confident of spending money on new capex, right? When the capacity utilizations across the board are moving up, the next logical step is to put in more capacities, right? And that's what Indian corporates have been doing, and one of the big beneficiaries of that theme has been capital goods company. The third theme that we have capitalized on, and which has worked really well for us, is pharma. And within that pharma, I think what we have capitalized on is the CREMS opportunity, right? So that's the third theme that we have done, as a part of our overall portfolio. Having said that, our portfolio is a fairly diversified portfolio, right? When you speak to people and tell them that, this is manufacturing focused PMS, a lot of people tend to think that it's a fairly myopic view. It focuses only one part of the economy. But like I said, within manufacturing, there are at least about 12 or 13 odd industries. It's a fairly diversified portfolio that we have built. As a part of our portfolio, we already have 9 industries within manufacturing as a part of portfolio. But like I said, these are the 3 sectors where we are overweight at this point of time. I think if I look at future over a bit of next about, let's say, 3 to 5 years, if this whole manufacturing theme is going to work, if Indian consumption is going to move from, let's say, sustenance or subsistence kind of spending to more indulgence kind of spending, in layman terms, if I were to tell you where we are moving from roti and kapda to we are moving makan and more, right? And as that happens, we are going to spend a lot again over a period of next 5 to 10 years on capacity expansions. And I think some of these consumer discretionary spend related manufacturing, capital goods related manufacturing, and global exports related manufacturing, where it could be pharma, it could be auto ancillary, it could be crams, it could be chemicals. Some of these themes are going to do phenomenally well. I think that's where we are going to place our bets.
Great. So India is growing and NV fund is growing along with it.
Yes.
NV strategy is growing
Yes.
along with it. That's great. So we'll move on to the next. We have also observed that long-term picks are a key feature to your fund management. Which are the longest and most consistent stocks that you have held?
So in terms of portfolio, Prachi, what we usually look at is, if let's say there are 20 stocks, like they are my 20 children, right? Each of them is near and dear to me. I mean, I'm not stepfather to either of them. So yeah, all 20 that we have, or all, let's say 15, 20, 25 stocks that we have, every stock is near and dear to me. But if you ask me within that, what has done phenomenally well for last about, let's say, 12 to 18 months for me, I think capital goods is something that which has done phenomenally well for me. And within that, some of the stocks like Elecon Engineering, Centum Electronics, Larsen and Toubro in large cap is something that has contributed significant alpha to the portfolio. What is also, and also, one of the positions that we have already, probably exited, Voltem Transformers, is something that has done phenomenally well for the portfolio. In terms of auto ancillary, what has done well for the portfolio is Eicher Motors. To some extent, Igarashi Motors is something that we have, held on to. What has also done well for us is some of the names in the, let's say, the export side within auto ancillary, where we have a position in endurance technologies. So yeah, these are some of the names which have done really well for us for last about 15 to 18 months. But like I said, all 15 names which are part of the portfolio, all of them are near and dear to me. We are going, and when we build the portfolio, usually a portfolio is built with an intent in mind that each of these positions we are going to hold on for next 3 to 5 years. That's how the estimates or forecast are built. And with an intent that over a period of next 3 years as a portfolio, we are going to grow our earnings by 2x, which means anywhere between about 23 to 26% growth in earnings. What would also benefit us is the PE expansion over that period of 3 years, and eventually the portfolio should, at the client level, should earn any return which is between, let's say, probably 2.5 to 3x of what the risk-free rate of return is. So these are some of the names which have done phenomenally well for us.
That's great. I'm making mental notes for it. So the last question would be, investors are keenly awaiting the wave of growth. The current market levels, do you think it's the right time for the investors to enter in their investments at current levels?
So, if you're going to be in the market for long, I would say timing market is probably less and less important than your time in the market. I would suggest investors that you better, work on how much time you're going to spend in the market rather than timing market itself. At any point of time, if you're going to build a portfolio of, let's say, 20 companies which are best in their own industry at the right prices, it doesn't matter at what point of time you build your portfolio. Even if you look at market returns from the peak of global financial crisis prices, prior to the GFC, you would have made decent returns from the market, right? So I would say, any time to be in the market is a great time to be. Having said that, I think overall we also hold a view that this is the time to separate, men from the boys, to separate wheat from the chaff, which also signifies the fact that in pockets of market, we are seeing valuations which do not justify the growth of that particular company, right? If you're looking at valuations which are for a small cap company 75, 80, 100 times, of their earnings, and their earnings are not going to grow at probably doubling in 2 years or 3 years, that's not the kind of price that we are willing to pay. More often than not, our in-house equal model, MK quality framework model that we follow, takes care of that pricing dichotomy, where we match the kind of risk that the investor takes on a particular business or a promoter, and try to understand that over a period of next 3 years, what's the kind of rate of return that he has to earn from that investment, both at the individual stock level as well as at the portfolio level. And that's how you take care of the discipline of the buy price. We also maintain the same discipline when we sell the stocks, that if a particular kind of risk on the promoter or in the business is no longer justifying the kind of residual return that I'm looking at from the investments that I've already done, we have not shied away from booking profits also, right? So you take care of your pricing discipline, both in terms of the prices at which you are buying, and when I say buy price, what I mean is valuations, right? Price to earnings ratio, price to book ratio, EV/EBITDA, whether you're looking at price to cash flow. You take care of that discipline on the buy price. You also take discipline on at what price you want to sell and execute your sell trades at the right time. And I think you should be home. I think, like I said, time in the market is significantly more important than you timing the market. The best of the investors, I would say, the smartest of the investors haven't been able to buy at the lowest. They have not been able to sell at the highest, right? So we are mere mortals, right? We
Nobody
can't do
catches the
that,
full cycle. That's
right?
correct.
So that's what my suggestion is to the investors.
Perfect. So, moral of the story is you have to stay in the market to get the returns, or
Right.
you just go with the experts
Right.
who have perfected it. So, thank you very much for your insights. That's it for today's episode of Fund Managers View. Thank you.
Thank you so much.